As promised, here are charts that I would like to look at you, which I think are very illustrative of the rise and decline of the American economy. This chart is the United States gross domestic product growth rates since the 1930s. 1930s, that's the Great Depression. The average growth rate was 1.3%. 1940s, the highest in our history, 5.9%. In the 50s, 4.1%. That is nevertheless considered to be extremely healthy. You people have seen these exorbitant double-digit figures before in China. They're sort of irrelevant to what was going on in the United States because the United States didn't develop suddenly. In the 1960s, you see us again at a growth rate of 4 point, depending on whose source you believe, 4.4 or 4.6. The ones on the right with the asterisks are from Robert Brenner's book, The Boom and the Bubble. He's a very, very famous political economist and economic historian. The 1970s, this is what we were getting around to, a dramatic decline in growth, 3.3%. And as I said before, countries were asking for payment in gold, and the industrial apparatuses around the world were catching up with the United States so that their cost per item was more and more comparable to the United States, or even better, that is, item or service produced, became better than the United States. Okay, Reagan comes into office. Oh, what I should also add, very important, in the early 70s, there was a humongous recession from 1973 to 1974, in which there was a so-called Bretton Woods II. And since gold was being drained out of the United States, it was decided that the world's currencies would still be pegged to the dollar as the reserve currency, but the worth of all currencies would be in accordance with the total production and specifically the productivity, the efficiency with which each country produced goods and services. So during the 1980s, despite the fact that there's all this great cheer about Reagan, there wasn't significant growth in the economy actually at all. It was somewhere between 2.9 and 3.1%. And you can see going into the 1990s, there was an uptick under Clinton. And that mostly occurred because of the dot-com bubble and the bubbles stock market bubbles that were created, what Alan Greenspan called irrational exuberance that hung on for quite a while, and also the very, very great upgrowth of people buying electronic computer materials. In the 2000s, under Bush, growth is only between 2.1% and 2.6%. So any bravado he put out, frankly, was bullshit. Excuse my French, please. So in any event, what happened in 1973, 74 was extremely dangerous because it made currency speculation very, very easy. People could make runs on money. For example, billionaires like George Soros could suddenly say, I have a bunch of pesos. I want dollars for my pesos. And then other people would follow him. And they ran under the rules of the market. And therefore, if there was a great demand for dollars by converting your pesos into dollars, the value of the peso would go down. This is one of the methods by which George Soros got himself very, very rich. Let's look at some profit rates, also to give you an example. These upper ones are manufacturing profit rates in the U.S. since 1959. By manufacturing, these statistics also include heavy industry, but they don't include the FIRE sector, finances, insurance, and real estate. Nevertheless, look at the profit rates from 1959 to 69, corporate profit rates, 20.8%. We are declining in the 70s from 69 to 79, profit rate 17.9%. 1979 to 1990, 15%. 1991 to 2000, 11.9%. 11% rounded. And in the year 2001, 8.3%. Those are the latest stats that I could get from Robert Brenner. Below is actually total corporate profit rates, which actually do include financial institutions. But what you have to keep in mind is that the profit rates of financial institutions until this decade that we're in were always much lower than manufacturing and heavy industry. They dealt in interest. Whereas in heavy industry, you might get returns of 10%, as you've seen on the charts, or more. Whereas when you invest in bonds and so forth, you're rarely going to get interest returns that are in the double digits. Nevertheless, if you look at, you can again see the decline in profit rates of American corporations. In the year 2000, it is 6%, okay? And this is according to Erdogan, Bakir, and Al Campbell, who drew a lot of stats from the Bureau of Economic Analysis and wrote an interesting article on the neoliberalism, the rate of profit, and the rate of capital accumulation. 2005, 5% profit rate. Bumps up a little bit in 2007, and then of course 2008 is not very good as the whole economy crashes in September and runs a lot of risks up to then. There was a Bear Stearns crisis in February of 2008. 2007, the recession actually begins in December, but before that point, the economy was turning acceptable profits, I guess, and that's why the figure is that high. All right. Talking about the large picture here, you see these declining rates of profit, especially in manufacturing and heavy industry. What are big investors to do? And a bunch of geniuses, some would say sociopathic geniuses, come up with mathematical formulas and create new financial instruments, such as mortgage securities, a whole family of investment instruments called derivatives, collateral debt swaps, also, yeah, and so on and so on and so on and so on. It gets pretty outrageous. It's still outrageous. Believe it or not, Goldman Sachs has $90 trillion in derivatives on its books. That's absurd, because the company is not even worth $200 billion. And in fact, the total net worth of everyone in the United States is only in the neighborhood of about $55 trillion. Yet a lot of these derivatives that they keep on hand are cheap. Like again, credit default swaps, which are insurance in case a company you've invested in goes belly up. And of course, some of you are familiar that a common financial practice was indeed to buy a derivative of some kind and then take out insurance on it if it collapsed. And your insurance premium would be pretty slim, so that either way you would make a great profit. In any event, we're now looking at income tax rates. And you will notice how exorbitant they once were, yet the United States made a great deal of profit, in 1948, after the first $100,000 earned, the tax rate was 76.9%. You can see 1960, when Kennedy wins the election, it's 85.5%. This is called effective tax rates, what the government estimates after loopholes, etc., that it was getting. 1980, however, 1975, 68.6%. There's a change in 1980. People forget about Jimmy Carter. This was enacted under Jimmy Carter's administration, and so on and so on and so on. The last figure that you can see is the effective rate, right, for the top 1%. These are all top 1%. Is 20.9%, okay? Corporate taxes, well, I think that we can continue with this in the last lecture, finish off this section, and start with the future of things to come.